Welcome to the Art of Money Podcast with Art McPherson.
And this is the Art of Money Podcast with Art McPherson and Luke McCarty, artofmoneyradio.com for more information on the McPherson Financial Group or to schedule that initial complimentary consultation. We appreciate you listening. Now, let's get to the show. Art McPherson, Luke McCarty. It was this weekend back in 1973. President Jimmy Carter admitted he had seen a UFO a few years earlier. So I started getting down a wormhole of Americans and what we believe in UFOs. 40% of Americans believe in aliens. 11% believe they have seen one. However, Art McPherson, only 38% of adults have a financial advisor. So we believe in aliens more than we believe in financial advisors. That's terrifying.
Have you seen the government lately?
I mean, guess it makes sense.
Yeah, exactly.
Yeah.
No, I mean, it just shows you, I think a lot of people don't feel like they can afford an advisor or that they have enough money to talk to an advisor or something along those lines where people haven't put it as a priority. And it needs to be because their retirement is going to be a big deal one of these days. Some people think, well, I'll just work my whole life. Physically, you can't always just work your whole life. You know, you might have medical issues, things like that. So even if you want to, doesn't mean you will. And sometimes you don't have the aptitude to work your whole life. You either physically wear out or you mentally can wear out and your position is not available because we all slow down as we age out. So you just have to remember that. So there has to be some money that you put aside. And that's all you're basically doing is not living on every dollar you make today. Mm-hmm. You're basically putting money aside for the future so that that money can grow and compound for you while you're waiting and get the magic of compounding so that for every $100 you set aside in your 30s, you should be able to take $500 or $600 out a month when you're retired. So it's really a smart thing to do. And anytime you save money, and you know how it works, Mark, it always seems like there's something there to grab it, right? So you save money, you're going on a big trip, and what always happens? You have to get a new tire for the car, or you have a transmission goes out. Why? I don't know why that always happens, but it's just the way it is. So having that extra money, having those extra resources for retirement planning, for trips, travel, maybe you've got a great trip planned and all of a sudden we've got to use some of that money for some healthcare costs. But if you've got it set aside, then you always have it. What you will not be able to do in retirement is not save anything and just be able to live off Social Security. That's not going to be a good retirement.
And I think, Art McPherson, something that you do as well that we don't think about. You said earlier that, hey, I'm just going to save my money and I'll retire off that. Well, you build those plans that have those extra buckets. So the emergency bucket, the travel bucket, I called it the degenerate fund where I like to go to a casino fund. This is not something that I'm going to do on my own. So that's why we say 38% of Americans get it right when they call a financial advisor. And you can be part of that 38% when you call 772-281-5223. That initial consultation, no cost, no obligation to you. To sit down with Art McPherson, Luke McCarty, they're going to customize a plan for you. And that also includes building that estate plan. CNBC published a story about the financial challenge of a woman who lost her husband to COVID. She said, we planned for life, but we didn't plan for death. Now, Art, Luke, it's not really a cheery topic, but when you have this conversation with clients, how does that go?
Most of the time, clients don't have things set up. Mm-hmm. The ones that do, oftentimes there's a couple holes in it. So in the state of Florida, you definitely want to avoid probate. And, the conversations around that, just like she said, we planned for life, but we didn't plan for death. Well, it's going to happen. You need to talk about it, even if you don't want to. I recently sat down with some clients and we were planning, and we pre-planned this for him, to have his wife there with us. And we planned for his death in different scenarios within our software and made her sit there and think about it. That sounds horrible, but she sat there and thought about, okay, what if he dies next year? Huh. What if he dies in 15 years or 20? Or then, the normal life expectancy, 30 years. And it was with, if we did this and this and this and kind of plan it out so she could make decisions on whether it made sense or not for him to get life insurance or for him to get long-term care insurance, things like that. So even if you don't want to talk about it, it's definitely something we do every day, and I think it needs to be talked about. And if you do it right, you don't have to talk about it that often. Right. Just do it once, and if things change, you can always change your plan, but it's not a recurring event typically.
772-281-5223. To begin the conversation with Art McPherson and Luke McCarty, we continue to hear the gloom and the doom about what's ahead for our money. Economist Steve Hanke tells CNBC he believes that we are in store for a whopper of a recession because the Fed chair doesn't understand exactly what causes inflation.
He has failed to tell us that inflation is always caused by excess growth in the money supply, turning the printing presses on, which we had, remember, starting with COVID in February of 2020. And that is why we are having inflation now. And that's why, by the way, we will continue to have inflation through 2023, going into probably 2024.
Are these the types of conversations you're having with your clients right now about the economy?
A little bit less technical than that, but I think the frustration in his voice is the Fed can stimulate the economy and slow the economy down by raising rates. So they're claiming, from the Fed standpoint, that they've got to slow this economy down to check inflation. What he's just saying in that statement is the reason we have inflation is because of excess government spending that went on. There's nothing you can do to curb that because it's already been booked in because of the spending, other than the government not spending like that in the future. So he's saying all of this interest rate rises that they're doing right now is not going to help because of inflation's already been there and will continue to be there. So it's kind of like a moot exercise. All they're doing is slowing the economy down, which then can cause other problems. So that's why you can hear the frustration in his voice.
Mm-hmm.
Yeah, and part of what the statistics the Fed is looking at are kind of in the rear view mirror. And this is why every time the Fed raises interest rates, if you look at on a chart or a map, it's stair steps on the way up, as they raise interest rates, and then a elevator down because they do it too much for too long. Now, I think the Fed is definitely behind the curve. They should have done this a long time ago. But our expectations are they're going to, raise rates to about 4% by the end of the year. There's going to be a 0.75% this month coming up, and then they're going to slow down a bit and hopefully wait and be more data dependent and not have. I don't know if Powell has a cocktail or not before his speeches, but he was very confident and very stern in Jackson Hole when he was talking about losing your jobs. He didn't seem to care. So that's been the recent downturn in this market. So we'll see what actually happens, but the Fed needs to just be more data dependent and worry about the job markets more than they say they're going to.
All this conversation about a possible recession is exhausting because I feel like we've been talking about it for 6-8 months now. And now you hear some of these economists saying, well, it's not coming until 2023, maybe 2024. Why is there so much uncertainty about the technical definition of a recession and if we're in one and if one's coming or not?
So the technical definition should have never changed. I think what's difficult now is we can be in a recession from GDP, but the American family doesn't feel it per se. Mm-hmm. But usually when everybody's thinking one thing, the market does something different, right? If it were so easy to predict a recession, we wouldn't have them, or we'd have them, but everything would go to zero and then we'd buy back up. Right? It's not that easy. So there's a lot of people predicting a recession because historically the Fed causes recessions by raising interest rates too fast and for too long. But every time can be different. And we've had, I'd say, an anomaly or, weird times in the market ever since COVID. So we don't know what the Fed's going to do. You can't predict the recession, but you can see it coming sometimes. We don't necessarily see it yet other than a slowing growth rate.
Yeah. We have some clients that have been calling in. I've had a couple examples this last week where their companies are starting to lay off big groups of people. That's usually an indicator that things are starting to slow down substantially, where the employers are being proactive and they're cutting back on their most expensive item, typically, which is labor. Mm-hmm. So we are starting to see that. So these are kind of like shots across the bow that even though the economy hasn't really slowed that much yet, the data is beginning to suggest to these companies that things are slowing down. They're seeing their numbers and they're seeing their data, and their data says that they're slowing down.
772-281-5223. The importance of having that plan because the economy is up and down. And can your portfolio withstand this volatile market? Well, the best way to find out is to have the plan and most importantly, have the conversation with Art McPherson, Luke McCarty, and the team at the McPherson Financial Group. An option could be that 60-40 portfolio, which is a mix of 60% stocks, 40% bonds. It's been a very popular strategy for long-term investors. But Bank of America research shows that the 60-40 mix is on pace for the worst year since the 1930s. while JP Morgan says that it will prevail over time. So, Art McPherson, Luke McCarty, what do you think, especially with those nearing retirement, the ones that may not have that much time?
Well, it's been a very unusual year. We talked a little bit about this last week. We may have the absolute worst market in history for bonds. So when you have a 60-40 blend, that's typically 40% equity, 60% bonds, and bonds are going to do the worst they've ever done in the history of the bond market. It doesn't bode well for a 60-40 asset allocation mix. So it has made all the target retirement funds that are very common in a lot of the 401k platforms and plans way underperformed. And typically they are very non-aggressive. You know, they just do kind of a asset allocation blend of the equities and securities in the 401k, and then they blend them up into a mix so people don't have to worry about it. It's done for them. But those typically might be down 2 or 3% kind of year-to-date numbers, and they're down 14, 12, 15%. And it's just been one of those years where the market has been really tough on safe money, or what we typically call safe money. So if you look at the data through this week, you know, you have a stock market, the S&P, which is typically 5-6 times riskier than bonds, is down about 15% year to date, where the bond market is down about 12% year to date. So when you have one part of the market down 15, the other part that's supposed to be your safe money also down 12, it's not going to bode for a good year, Mark.
Mm-hmm. Yeah, not at all. So this is going to give a little bit different history for textbooks. You know, when you think of like the modern portfolio theory and you think of, you know, how to measure risk within a portfolio, we've never really seen this in the bond market, but yet the economy still seems to be going good, right? If you go out to dinner, you have to get a reservation, things like that. So it doesn't feel as bad as the bond market's telling us it is. So that could be one of two things. That could be either the bond market is smarter than everybody else and smarter than the stock market, or the bond market has this wrong, and we may see a big rally in bonds themselves. And that could potentially happen as early as next year, because when the Fed lowers interest rates, the bond market is positive. And that's essentially what's been happening since 1980, right? Rates have been dropping for the last 40 years until now. So bonds have been negative the last 2 years. So that 40% of your portfolio hasn't done very much for you recently.
Is the 60-40 mix? Would that be best for you? We'll give the team a call to find out. 772-281-5223.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174725.
Today's show has been a work of art.